Not long ago, high-income investment strategies like covered calls and modest leverage weren't just rare, they were reserved. If you wanted access, you had to be part of a private wealth management program at firms like Goldman Sachs, Morgan Stanley, or UBS. These types of divisions specialized in serving high net worth and ultra-high net worth individuals, typically people with between $1 to $10 million or more in investable assets. The average person with a few $1,000s in a brokerage account was simply not invited to the table. We're talking about an era around the 1980s through the early 2000s, the golden era of private wealth. These firms catered almost exclusively to high net worth individuals. For the ultra-wealthy, portfolios were customized with tax-optimized income strategies, option overlays, structured notes and modest leverage, offering protected downside with high income potential. Back then, if you wanted a covered call strategy, you didn't log into an app and buy an ETF. You would personally meet with a portfolio manager who would construct a separately managed account, SMA, using individual stocks and options contracts, manually writing calls to generate income. This required expertise, scale, and constant oversight, which meant high fees and limited availability. By the 1990s, structured products began to grow in popularity, like notes that mimicked covered call payouts or offered equity exposure with built-in income features. But again, these were typically sold through private banks, with minimum investments of $100,000 or more, and often carried steep embedded fees. The average investor simply didn't have access or even the knowledge of the existence of these types of products to participate in them. Back then, the tools were complex. Covered calls, for example, were implemented in separately managed accounts. These were often custom-built by a portfolio manager and used individual options contracts. The idea of putting this strategy into a low-fee, tradable wrapper didn't exist, and because options trading requires active management, the cost to deliver these services wasn't cheap. Again, these were built for wealthy private clients who had direct relationships with financial advisors or institutional consultants. The popularity of these strategies within those private channels was significant. Wealthy clients often wanted cash flow without having to sell principal, and they were willing to trade some upside for consistent income. Covered call overlays became a staple in many high net worth portfolios, especially for retirees or clients in low interest rate environments looking for yield. But all of that was behind closed doors, invisible to the broader investing public. If you were an income seeker that was just starting out with $5,000 or $10,000 in an online account, your choices were limited. Maybe a few dividend stocks or a mutual fund that paid quarterly. There was no way to tap into the same strategies that private clients were using to generate monthly income at scale. Today, that exclusivity is gone. In 2013, Global X launched QYLD, one of the first ETFs to offer a covered call strategy on the NASDAQ 100, targeting monthly income. This was a turning point for the industry. For the first time, everyday investors could access an options-based income strategy, once reserved for institutional clients, inside a single publicly traded ETF. By late 2010, more ETFs began to follow, like XYLD and RYLD, and eventually active income products like JEPI from JP Morgan in 2020, which brought institutional quality strategy into the ETF world, gaining over $30 billion in AUM in just a few years. Fast forward to today and the game has changed completely. Thanks to financial innovation and the explosion of ETFs, these once exclusive strategies are now available to everyone. No million-dollar minimums, no private advisor required. You can now buy into high-yield income-generating portfolios with just a few clicks, and in some cases with as little as $1. Covered call ETFs are now packaged into single tickers that anyone can buy. Funds like HYLD, USCL, and QQCL take broad indexes like the S&P 500 or NASDAQ 100 and apply leverage as well as call writing strategies to generate monthly income. By adding a layer of leverage, these types of funds are borrowing modestly to enhance the cash flow, typically around 25%, which enhances the yield and exposure to equities. There are now even higher-yielding niche ETFs that write covered calls on single stocks like MicroStrategy, MSTY, and even crypto-based income ETFs. These types of products offer yields that, in some cases, push far into the double digits. This is a massive shift. What used to require private consulting and high-touch execution is now automated, bundled, and publicly traded. Today, regular investors can tap into monthly cash flow, Option-based income strategies, modest leverage diversification, and all of it managed by professionals inside a low-cost ETF wrapper. It's the democratization of income investing. But with all of this access comes responsibility. These strategies still carry risks. Capped upside, potential volatility, sensitivity to market cycles. Ultra-high yields can be misleading if you don't understand the underlying mechanics of each fund. Still, the fact that we've gone from million-dollar minimums behind the closed doors of advisors to full accessibility on platforms like Wealthsimple, Fidelity, and Quest Trade is a financial revolution in itself. This isn't just innovation, it's a transfer of power from Wall Street to Main Street, and we're here just in time for it. Me, I couldn't be more excited. The future looks bright, guys. Catch you in the next one.